Hello, I'm Brent Joyce, Chief Investment Strategist at BMO Private Wealth. It's Wednesday, October the 1st, the beginning of the fourth quarter. Welcome to our Global Markets Commentary. Equity markets climbed a wall of worry over the summer. Despite negative headlines, earnings growth dominated, propelling stocks meaningfully higher. Equity markets lead earnings, which in turn lead the economy. Corporate earnings surprises have augured an uptick in expectations for future economic growth. These revised growth expectations, coupled with the resilience of consumption, expansion of business investment and capital expenditures, the growth of artificial intelligence, data centers, and an infrastructure boom, are fueling a virtuous circle for the economy and capital markets that looks to extend into 2026 and perhaps beyond. Given the positive backdrop and the extent of the equity market gains, it is natural to worry about valuations. Average price-to-earnings valuation multiples, or PEs, are currently elevated compared to their historical averages. Assessing investment opportunities on PEs alone, or even broader valuation metrics, has historically not been a useful timing tool. When the backdrop is favorable and sentiment is positive, as it is today, elevated multiples are to be expected. It is true that when speculation takes hold, valuation multiples rise. But forward earnings ratios in the most expensive and AI-centric market, the S&P 500, are roughly where they've been for the last 5 years. Notably, for the Magnificent Seven, substantial earnings growth has led to lower PE multiples. We need to be careful not to paint a whole picture with one broad brush or be too dogmatic in our thinking. Avoid a "I don't want to invest in the stock market, it's too expensive" mentality. There is a lot for investors to like about the current environment, one where the economy is performing reasonably well, but employment remains weak enough to temper wage inflation and prompt central banks to ease monetary policy. Central bank rate cuts that coincide with rising earnings growth have historically been very bullish for stocks. The most common concerns we hear are how will tariffs, inflation, and the U.S. government's large deficits impact my investments? Well, there are nuances and drawbacks to each of these. We view equities as a good hedge against all of them. On tariffs, corporations are adapting to tariffs slowly, dampening the impact and spreading it out over time, making it easier for the economy to digest. For inflation, it can stay elevated as long as it doesn't go too high. Think north of 3% for more than a month or two. Companies are a part of the inflation mechanism. If companies aren't raising prices, there is no inflation. The shares of well-managed companies tend to rise as earnings increase, even if some of that is due to inflation. Lastly, government finances. The idea that tariffs are here to stay and can be absorbed is becoming so well entrenched that a reversal of tariff policy, by the courts for example, could be viewed as a negative by capital markets. Initially, the bond market didn't like tariffs, viewing them as inflationary. Given the level of U.S. government spending, tariff revenue is helping to lower the U.S. deficit and is now considered a positive. Equities aren't just a tool to insulate against these risks. They embody all the benefits of innovation, entrepreneurism, and capitalism. Ultimately, for equity investors, earnings are the lifeblood. Earnings growth drives share prices and funds buybacks and dividends. Earnings aren't just beneficial for investors. They also serve as a good indicator of the economy's health. Earnings lead everything. They are doing so today and pointing to positive developments ahead. That's the way we saw the third quarter of 2025. Thank you for joining us. We look forward to you tuning in next month.